Today we're going to take a look at a company that hasn't really achieved over the last 1 to 5 years. Over the last year it's down about 14% in share price value. Over the last 5 years it's up 22%, but when you split that over 5 years it's not a huge annual return. So they've not been doing too well, but the numbers are looking okay. Today we're going to take a look at a company called Sage PLC. Hey there guys, how's it going? So first of all, before we dive into this, if you can continue to smash that like button and help me get to 40 likes a video or more, that would be awesome, because it just helps me out. It means that more people get to see the video. You know, I'm essentially doing this and sharing the information that I'm finding because I want people to be able to see it, and I like sharing what I'm doing. And there are so many investors out there that are picking dog turd stocks. I mean, even today I had somebody contact me on Facebook saying that they'd bought into Centrica, and I was just like, oh, why Centrica? What is so popular about Centrica? And this was a long-term investor, someone who was going to hold this position for 5-10 years. I mean, unless something dramatically happens at Centrica, their share price isn't really going to go anywhere, and there are such better places to put your money. So I'm really positive and keen and optimistic about sharing what I'm sharing, because I know it will help people. And so when I get 40 likes, we were getting 20 likes before, then we were getting 30 likes, now we're hitting 40 likes plus on these videos. It's awesome. Please keep doing that for me. Like I say, it gives me the fuel to keep going, and it means more people get to see the videos as well because of the algorithm or whatever. So that's awesome. Today we're going to take a look at Sage PLC. Get my words out properly. Sage are a accounting company. They do accounting software, and I've used them in the past for working at different companies, working for myself, all that kind of stuff. They used to do payroll as well. I don't know if they still do that now. But they 6.5 million shares traded a day, so they're not the most popular company out there, but there's plenty of activity going on for sure. In recent years, the return rate has not been that solid, but let's go and take a look at the numbers and see what we find. Okay, so let's take a look at Sage Group PLC. Epic code is SGE. They're in the FTSE 100 index, and they are in the software and computer services sector. Let's take a look at the actual numbers then. So revenue has clearly been going up. I would say that we've had quite a flat period by the looks of things between 2008 and 2014. There wasn't a lot of growth there. We seem to be kind of sat at about 1.3 billion for much of that period of time. Consistent. Every year they were achieving that sort of amount, and it wasn't going in the wrong direction, but not really growing until 2015, when they reached 1.4 million. 2016, another 1.4 billion, I should say. Then 1.7 billion in 2017, 1.8, and then 1.9 in the most recent report. So certainly over the last 6 years, we've seen some consistent year-on-year growth, I would say, but kind of flat over that period of time here from 2008 to 2014. But that's good. The last 6 years we've seen some consistent growth year on year, and that's what we want to see. So revenue is growing. It means that Sage Group are able to get out there year after year and find more revenue to bring into the business. So that's a good sign. Cost of sales has been relatively flat. It's looking like it looks like it's risen along with that revenue, which is fine. Back in 2008, we're looking at the cost of sales costing them about 3% of their revenue, and that's essentially the story today. They're keeping 93% of the slice of the cake after cost of sales, and they have been now for quite some time. Obviously, it's been up and down in the interim between 2008 and 2019. But we're still pretty much there. It's consistent in so much that every single year, no matter if the revenue goes up, the cost of sales goes up with it, and they generally keep about 93%. So that's fine. Expenses, similar story. 78% in 2008, 78%, 79% in 2019. So the expenses of running the business are also increasing, but again, they're increasing at the same rate as the increase in revenue. So as they're bringing in more business, about 78 79% of that revenue is being spent on the expense of the business, but it's obviously sticking at that rate every year, so that's fine. There's a couple of spikes in there. I'm not too concerned about those. And then we look at R&D, depreciation, nothing in there at all. They're probably incorporated in the overall expenses. That's fine. They just don't break them down. That's not an issue. We can look at interest on debt. That's down at 5.5%. Has been well under 10% for a long time, so that's nice and healthy. So that's not an issue. Looking at net earnings, they're looking at about 13 to 14% consistently every single year. There's been a couple of years where they've been above that. You've got 17%, 19, about 18 there, 16% in 2018. And then we've got this losing year here, well, not the losing year, sorry, it was a 3.5% net earnings. They made 47.5 million in profit, which nothing compared to what they've been doing previous years. Looks like that was largely due to a spike in expenses for some reason. But they seem to have certainly come off the other side of that now, and they're back to their consistent ways of achieving about 13 to 14% net earnings a year, which is healthy. It's okay, you know. These are what we're seeing here is solid. This is a solid company. It's not, you know, the most exciting company we've seen, but certainly not the most exciting company I've seen. But I do really like the consistency here. There is growth and everything is running at a consistent level. So, you know, we're looking at about 14% on average per year net earnings, which is good. You can't really scoff at that too much. We look at the balance sheet. Assets outweigh liabilities in the short term. Current assets against current liabilities by 0.7. It's okay. Nothing particularly exciting there. It'd be better if they had a few more assets in there against current liabilities, but it's not terrible. Assets have been growing by the looks of things, from 2.5 billion to 3.3 billion over the last 11 years. So that's pretty good. Look, long-term debts. Long-term debts are, I would call that flat. 575 million in 2008, 463 million in 2019. It's been up, it's been down along that way. What I'm more interested in is the weight of that debt against what they're able to earn. And based on their current earnings of last year, or the most recent year that we've had of 266 million, they're borrowing 643 million, or that's what they've got outstanding in terms of long-term debt. That means that if they were to use all those profits to pay off that debt, it would only take them 2.4 years, which means they're not biting off more than they can chew. They're carrying a level of debt that they're more than capable of paying off when they want to pay it off, or if they need to suddenly start paying it off. It was bad this year. It wasn't necessarily because the debt had grown too considerably, although it did make a jump. This was more down to the fact that they didn't make much profit that year, and therefore that kind of screwed with the figures a little bit. But at the moment, it's at 2.4 years, so that's pretty good. That's really healthy. The other thing I really want to look at is the retained earnings, from 640 million to 760 million. So we saw growth from 2008 here all the way to 2011. Then we've seen decline 3 years in a row where they were just dipping into those retained earnings. Now, that might be because of acquisitions. It may have been because they were using that money to invest in the business in some way. Not sure. But they have been growing again since 2014, consistently year after year. So we're talking about 6 years of annual reports where the retained earnings have been growing and growing and growing. And over the last 5 years, we've got an average growth rate in their retained earnings or cash reserves of 44%, so 44% average increase a year. So that's really solid, really good. And the return on shareholder equity is looking really healthy too. Capital expenditure is well within the limits of what I'd want to see. So overall, Sage looking really good. There's not too much negative in here. I did notice that they're not buying back any of their own shares, which is a shame because I do like to see that. But otherwise, this is a company that are ticking the boxes and they look good, but they're not. The numbers are not blow your mind exciting. So they're consistent. They're doing a really good job. It's a really solid business. I like it, but they're not blow your mind figures. They're not like, wow, these guys, are one of the best companies I've seen. That's certainly not the case. But I do think they're going to score pretty well on the leaderboard. Let's take a look at the chart. Okay, so this is a copy of Sage Group PLC's chart, and we're looking from 2008 all the way to present day. obvious share price growth there. So this is again indicative of the fact that when you tick the boxes and you've got consistent numbers, even if they are not blow your mind superb numbers, you're still going to see some share price growth. And we've seen Sage go from in 2008 to from about, where is this? 2008, mid 2008, we're looking at about £2 a share. Now sitting at £6 a share, has been a lot higher. We've seen this massive drop. Incidentally, today, for some reason, Sage Group, we're recording this on March 16th, by the way. Today, a bit of a jump here, and I don't believe many UK companies saw a similar jump like that today. So that would be interesting to find out why that might be. So that looks pretty solid. It's definitely a growth stock. And if they continue to keep churning out the numbers that they've been churning, and we continue to see growth in those numbers, then I'll expect to see this share price continue to go back up during the recovery of the market crash that we've just experienced. So yeah, pretty good. Okay, so considering this stock has not achieved particularly well over the last 5 years, we're only looking at a 22% return. That includes recent events, March 2020. We won't say the C word, but this is a stock that has underperformed in terms of share price growth, but it is a growth stock, and it is decent. I think what's happening there in terms of the numbers would suggest that this is a decent company. You could do a lot worse picking this company, evidently, from some of these companies that people are so quick to jump into. Sage are actually a decent choice, and they're not terrible. And if somebody turned around to me and said, look, I'm going to be buying a ton of Sage shares this week, I would say, yeah, good luck. It's decent. It's not a bad company, and you could do well out of that. So, because the numbers suggest that this is a company that is growing, they are ticking the boxes in terms of what I look for in a growth stock. And I just think the last few years, it's just not quite been... hasn't quite worked out for them. If you read into that and you look at the data and you do a bit of research, you'll find that they've made some transitions recently in their business around the way they're doing things, transitioning to a membership program and moving things to the cloud and all this kind of stuff. So maybe that's had an impact in the last 5 years. I like them. I like Sage, and I think there's a good future ahead of them. Let's chuck them up on the leaderboard then and see how they did. Yeah, not terrible by the looks of things. They've done all right. Sage PLC then, 6.5 million shares exchanged every day, 22% over the last 5 years, but I think there's somewhere for this company to go over the next 4 or 5 years once we recover from the recent market movements. Sage PLC scored 69 points. So that brings them to... Nearly knocked my books off then. That brings us to 4th place. That is pretty decent. This is the 4th best company we've looked at on this show after 16 episodes. So that gives you an indication of just how good this company actually are. So let's get them up on the board. Okay, so Sage have done pretty well. 4th place on the leaderboard. After 16 companies to be in 4th place, I think that gives you a pretty good impression of just how solid a company they are in comparison to many of the companies out there. If you want to get in touch with me at all, you can email me at chris@thecleantrader.com or visit the website thecleantrader.com. Otherwise, guys, thank you so much for watching, and I'll see you next week. Hey guys, before you go, I say this every week, but if you are enjoying what we're doing, we're going to be doing a ton more of these. We do one a week at the moment every Monday, but we're looking at bringing a Thursday show in as well, so that'll be 2 a week. We've just brought in a new member of staff that's going to help me be able to get through more of these companies, which it's only going to grow, essentially, and this show is gaining in popularity, which is awesome. I'm very happy with that. If you're enjoying this episode, please feel free to subscribe. We're going to be churning out way more in the future. Click that little bell icon as well to make sure you get notifications when new videos go up. Otherwise, thank you for checking out this video and watching it until the very end. See you later.